Hello, and welcome to today's Moss Adams webcast. Use private credit for shareholder liquidity and growth. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, I'm pleased to introduce today's presenters, Gassen Mosbahi from Moss Adams and Mike McQuigg with Gladstone Capital. Gassen is a partner in the deal advisory group at Moss Adams based in New York City. He also leads our private equity practice on the East Coast. His experience includes over 400 deals on both the buy side and sell side, with deal sizes ranging from 10 million to 3 billion. He assists our clients by providing quality of earnings analysis, valuation, and tax structuring services. Mike is the Senior Managing Director at Gladstone Capital and leads the firm's private credit fund. Gladstone invests in lower middle market companies across all sectors and is a leading capital provider to privately owned and founder-owned businesses in North America. And with that, I'll turn it over to Mike to get us started.
Thanks, everyone. So what we'll do today is we'll go do a quick overview of private credit, and then we're going to move to give some folks some ideas as to how they can use it to accomplish strategic objectives. So let's first start with the different types of debt capital options. So lenders are going to use an interest rate to put a price on the risk that they take. And different lenders have different risk appetites and return hurdles. So let's start with what we're obviously all familiar with, which is banks. Right? Banks are designed to take low risk, and they offer low interest rates to attract business for their firms. Reason being, banks are highly regulated entities. A big piece of their capital comes from depositors, and regulators don't want banks to take high levels of risk with their investments and potentially put those deposits at risk. So banks are going to tend to favor more established, larger borrowers, and again, offer a lower cost of capital. Private debt funds seek a higher rate of return, but to attract business, they're going to have to offer more risk appetite for their investments. And they could take more risk in a number of ways. They could lend more money to the same company that a bank would. They could lend money to a riskier company and that will not attract bank capital. So the bank says no, but the private credit firm can say yes to that transaction. Or they can offer their capital on more borrower-friendly terms than a bank would ever allow. They could include things such as no amortization loans, looser covenants, and allow dividend payments. So that higher rate you're going to pay is going to give you more flexibility. So if you move to the upper right-hand side, think of private debt as pricing the risk between low-cost bank capital and higher-cost equity capital. So the emergence of private credit is definitely a good thing for businesses. It offers a broader menu of capital options than only banks would ever be able to provide on their own. So if you look at the two different types of debt capital, on the left are asset-based loans. We're probably more familiar with this. These are loans that are secured by specific assets offered up as collateral. So the borrower will pledge some type of collateral, whether it's accounts receivable or inventory or real estate. And the bank would lend up to a percentage value of that collateral in the form of a loan. So the mortgage is obviously the most familiar example of an asset-based loan to all of us. It's very formulaic underwriting. The bank will try to establish the value of that asset. And this is very effective for revolving lines of credit, for real estate purchases, or equipment purchases. And banks do this side of the sheet very, very well. They have a very low cost of capital. They're often the best solution for asset-based loans. Then you have cash flow loans. So cash flow loans are secured not by specific assets, but by the stock of the business itself. So the stock and all assets not already pledged to another lender are posted as collateral for the lender. And these loans are made based upon the company's value and its financial strength, and specifically its ability to generate future cash flow. This is very useful for companies that don't have a lot of assets. So if you think a consulting firm or a marketing firm, they don't have factories, they don't have a warehouse full of inventory, but they've got a lot of cash flow. And typically the value of a company's cash flow stream is going to be greater than the value of simply their assets alone. So by using a cash flow loan, borrowers can often access more debt capacity than they could simply by using asset-based loans. And these cash flow loans, while they're more expensive, are often a better solution for more strategic transactions, such as we see here, funding acquisitions, buying out shareholders, using growth capital, or paying shareholder distributions. So the question often becomes, how much capital, how much debt can a business really afford? Let's anchor ourselves on a key concept, which is EBITDA. Right? You're not going to see EBITDA on your audit, but you can calculate it yourself by starting with your net income, adding back your interest payments, your taxes, and your depreciation and amortization. And EBITDA is used as a proxy for a company's operating cash flow independent of its capital structure. And it's a useful number because you often measure a company's value and its debt capacity relative to EBITDA. So rather than say a company's got $30 million of debt, well, what's that relative to? In this example, this is a company that's got a $30 million loan against $10 million of EBITDA. So we would say it has 3 turns of leverage. So 2 key metrics in assessing the maximum available debt to a business would include the loan to value and the fixed charge coverage ratio. So if we see the loan to value is the amount of the loan relative to the borrower's enterprise value as perceived by the lender. In this example here, we have a company with $10 million of EBITDA. It's valued at 5 times EBITDA for a $50 million enterprise value. And it has $30 million of debt. So 3 turns of debt on a 5 turns enterprise value business is a 60% loan to value. This is a pretty full level of leverage. Rarely will you see cash flow loans exceed 60% of the company's enterprise value. The second and probably more important metric is the fixed charge coverage ratio, right? How much debt can you actually afford with your free cash flow stream? So the denominator in this equation are the known debt service payments. When you take out a loan, you're gonna have to pay interest every month, and you're gonna have to pay principal every quarter or every year. These are relatively known amounts, and the numerator has to be greater than those outflows. So your EBITDA minus your capital expenditures minus your cash taxes has to be greater than your debt service cost for you to qualify for this loan. And typically you will see a minimum ratio of 1.1 to 1 fixed charge coverage ratio to get a cash flow loan. So on the right-hand side here in box 4, you'll see there's 2 different scenarios. Just as when interest rates rise, people's ability to get mortgages will decline. The same thing happens with cash flow loans. So in a 5% interest rate scenario, this company can afford $30 million of debt, and we've broken out the fixed charge coverage ratio for you here. But if you were to increase interest rates to 8%, you can only afford $25 million of debt because that interest payment goes up, all else stays the same, you're gonna have to take a lower amount of debt. And keep this in mind, as many cash flow loans are floating rate instruments. And many borrowers got into trouble back in 2001 when they took as much debt out as they could when interest rates were at a cyclical low. And then as interest rates rose in 2022 and 2023, this ratio started to break for many borrowers. So always keep in mind a floating interest rate scenario and can you afford the loan should interest rates be higher than what they are today. So how can we use this? Let's go through a couple of real-life examples of how owners and management teams used private credit to achieve strategic objectives. First one is an owner dividend. In this case, this is 2016. The owner wanted $30 million to fund investments outside of his business. These were startup investments and real estate purchases. He didn't have $30 million sitting around on his balance sheet, so how does he go get the $30 million? Well, he hired an investment banker who introduced him to a number of equity sources. The challenge was in 2016, he was a couple years into an investment into his business where he had a higher level of expenses that were building out new capabilities that in the future were going to deliver higher levels of revenue and higher margin. But at that current time in 2015 and 2016, they were depressing his EBITDA value. And when the investment firm, when the equity firms looked at his business, they said, look, you had 11 million of EBITDA last year, 10 this year. I'll value your company at 10 times. That's a $100 million valuation. You're looking for $30 million. You need 30% of your company. He disagreed. He said, no, if I weren't making these investments, I really would have had 13 of EBITDA in 15, 15 of EBITDA in 2016. I want a $150, $200 million valuation. And they had a disconnect. They couldn't agree on the price of the equity. So we said, keep your stock. Don't sell it. Take out a loan instead. We see $10 million of EBITDA. That's more than enough to handle a $30 million loan, even at a 10% interest rate. Borrow the money, make your investments, but keep your stock. And that's what he did. A couple years later, the investments that he was making in 2015 and 2016 paid off, and his EBITDA rapidly escalated, and he sold his business for $250 million. Had he taken that 30% deal from the equity investor, he would have had to hand over $75 million to them. Expensive capital for just a $30 million investment. Instead, by taking debt, he just paid $3 million of interest for 4 years, paid off the loan, and kept all of those proceeds to himself. So he saved a ton of money by using non-dilutive, low-cost private debt instead of equity. Banks rarely do these types of transactions. Taking the equity out of the business is difficult for them to do, but this is a very common transaction that we support here in the private credit universe. Next, partner buyout, right? So partnerships, you often find partners, owners that are at different ages or have different objectives, different exit points for their equity. And in this case, you had a rapidly growing consulting firm that had 5 retired partners that owned 20% of the equity, and they weren't generating any revenue. They were retired, sitting on the beach, and they wanted to sell. They wanted to get cash for their stock. They wanted to sell the business and move on. The current working partners saw things very differently. They saw a very bright future. They were willing to do a lot of work to grow the business. They thought it was a terrible idea to sell at this point in time. So how did they solve this? Well, they worked with a private equity firm to have a deal where the private equity firm would buy the 20% ownership from the retired shareholders. And they agreed on valuation. The challenge came with the restrictions that came on that money. So the minority investor had to have certain controls on the business because they didn't control the board that allowed them to get their money out, but also to protect their investment. On the right-hand side here, you see a sample of some of the minority investor consent rights that they required that gave the partners that were staying a lot of heartburn. They weren't willing to give up this much control over their business to a new outside institutional investor. So what did they do? Well, they switched to a private credit deal. They, instead of selling the 20% to an outside investor, the partners that wanted to stay bought them out, and they used the cash flow stream of their business to get a private credit loan to buy out those partners and give themselves a small distribution. So they didn't cash themselves out, but they sprinkled $16 million amongst them. By buying the equity, all the future value that they created, all the equity appreciation went to them. They didn't have to give 20% of all that upside that they created over the next several years to the private equity firm. It all accrued to them. So they were right. EBITDA doubled in 4 years, and now they own 100% of their business with no outside investor on their board or with a 20% take of the proceeds. Next would be using debt, non-dilutive capital to effectuate an organic growth strategy. So in this case, this was a single market restaurant chain that had 25 stores, and they wanted to expand into new markets. They knew the concept worked, but they wanted to go outside their core market. And it would cost them about $1 million to build each new store. And once open, it would generate $400,000 of contribution to the business. So they needed about $15 million to fund these 14 new stores. So they went to the equity markets. And the equity investors looked at their business and said, look, you're doing $5 million of EBITDA. Because you're only in a single market, you're really only worth 6 times EBITDA, which gives you a $30 million enterprise value. And you've got $10 million of debt on your business today. So your equity is worth $20 million. You want $15 million from us. We're going to have to take control of the business, which the owners didn't want to do. Next, in number 3, they decided to go to their current lender, who had a multi-year relationship with them at a very low interest rate. But again, banks aren't willing to go as deep in leverage as private credit firms. So the bank only wanted to go up to 2.5 times leverage, which would create $2.5 million of incremental capital. They barely opened 2 new stores with that. So going the bank route wasn't effective. What ultimately got them what they wanted was a private credit loan. So as a private credit investor, we were willing to go up to 3.5 times EBITDA, which is a $17.5 million loan. They used 10 to pay off the bank, and there was $7.5 million left over. They used that to open up their first 7 stores in year 1. They open up the 7 stores. Each store creates incremental EBITDA. So at the end of the year, their EBITDA grew from 5 at the start of the year to 7.1 at the end of the year. Well, 3.5 times the $7 million EBITDA number unlocks new debt capacity. So they ran it back again in year 2. They borrowed another $7 million, opened another 7 new stores. And after 2 years, they had achieved their growth story without selling any of their equity. And when they went to exit the business, they had unlocked new markets, so they were now worth 8 times EBITDA. They had grown their EBITDA because they expanded to 14 new stores. So they sold it for 8 times the $9.2 million EBITDA. And in 2 years, they more than doubled the value of their equity by using private credit instead of selling equity. Really good example of using non-dilutive capital to effectuate an organic growth strategy without getting too deep in leverage. Then lastly is the one we're probably all familiar with, which is buying a competitor's business. In this case, this was a Southeast-based commercial fence installer, and a smaller competitor in an adjacent market in Texas wanted to retire. And a private equity firm had contacted them both and said, hey, we'll buy your business in the Southeast for 7 times EBITDA. We're going to go roll up some smaller competitors at lower multiples. The Southeast owner said, look, I'm at 7 times EBITDA today, but I could do this myself. I could buy the Texas business. And I know that when I combine his business with mine, I'm going to save at least $3 million of redundant expenses. So I'll get incremental EBITDA, but I'll also be in a bigger market. So that's what he did. He took out he used a private credit loan, took out a $22 million loan, which was only 2 times the combined EBITDA of the business, bought the business, achieved the $3 million of cost savings. And then when he went to sell, after he had done the deal himself, he got a higher multiple. So he sold that at 9 times. And he got that multiple applied to not just the combined EBITDA, but also the $3 million of cost savings that he put in place. So he sold 9 times, $14 million of EBITDA. He almost doubled his equity value in 1 year by doing the deal himself using non-dilutive capital. And at no point did he really put his business at risk. He took out a loan that was worth 2 times the combined EBITDA. So by no means sky-high leverage, but a very smart way to use private credit to increase his equity value. So those are ideas. Those are real examples for the folks on the call to think about and whether they're relevant to their business. But we'll dive in a little bit into the different options and what the debt capital raising process looks like. So as we walk through the examples, we talked about, look, private debt is a faster transaction than raising equity. A debt deal typically takes 2 months. Equity deals take 3 to 5 months. Again, you're not giving up board seats or voting rights with debt. You're going to have covenants with the debt package, but you're not giving up a vote or you're not giving up control of your board of directors that could potentially have a disagreement about the long-term direction of your company. It's easier to replace a lender. If things are not going well, all you have to do is pay the lender back, and it's a very easy number. It's their principal amount. There's no fighting over valuation like there is with equity. So should it be time to end the partnership, much easier to unwind debt transaction versus an equity deal. That said, debt's not always the right answer for all companies. Equity is often a better choice if companies have limited visibility into future cash flow. So what a lender is going to want to see is, can you reasonably forecast your future cash flow, and is that cash flow stream enough to cover and pay back my loan? Not every business has that type of visibility. They could be very seasonal, they could be lumpy period or have periods of operating losses, or cyclical industries. Doesn't mean they're bad businesses. It just means it's difficult to put high levels of debt on companies that have those dynamics. Similarly, you could be in a phase of your growth where profits are not the priority. You might be in a phase where you're really trying to capture as much revenue as possible and willing to give away profits in the near term. If you do that, it can be difficult to service debt. So if you think about what a venture capital business is often trying to do. They're trying to grow. Profit's a secondary issue. It will come later. That works with equity. It doesn't work as well with debt. And then lastly, some companies have regulatory requirements on the amount of debt that they're allowed to take. So keep all these things in mind as you explore whether debt or equity is the right option for you when you're trying to fund your transaction. So what does the process look like? What do lenders care about? It's a good idea to hire an investment banker to help you with the capital raising process, but it's not essential. Many folks do a pretty good job articulating their company's story and answering the lender's questions on their own. But largely, what I put down here are there's 4 key pieces of information that you want to use to convey what the lender needs. You're going to prepare an information memo about your business. Describe everything you can about the company, its growth prospects, its industry, its competitors, its challenges, and then have a presentation. You want to sit down in front of your lender and answer questions in real time. Even the best SIMs are going to leave open questions or even lead lenders to think the wrong way, but having that interaction through a presentation is extremely valuable, and it will help you tell the story the right way to your potential lending partners. You've got to have a projection model. As I said before, lenders care a lot about, can you look around the corner and tell us what's going to happen in the future so that we know that our loan is going to be safe. So show that you can project your business with a detailed projection model. Then lastly, there are just going to be some confirmatory questions. Put those materials in a data room. These are things like leases, key customer contracts. They're going to require a lot of data, and these are the 4 tools at which most borrowers convey this information. The bullet points here, this is what they're really going to focus on. As they go to their investment committee, they're going to get asked about all these various areas, and it's your job to use the tools above to articulate the story, and can you mitigate any risks that might be on the business. Very important. Avoid handing information over to a lender and hoping that they get to the right answer. It happens more often than you would think, but it's your job to make sure that you tell the story and articulate what the right answer is. In many cases, lenders can get a piece of information and go down the rabbit hole thinking that they know something that just isn't true. So don't rely on the lender to get to the right answer, looking at raw data. Communicate, talk, have phone calls to review information that you send over and make sure that they're processing it the right way. But ultimately, you're trying to give a data-driven answer to their questions, and this is where the bulk of their questions are going to come from. So we mentioned before covenants, right? So a lender is not going to have voting rights on your board. They might have an observation right, but they're not going to have voting rights. So what do lenders use to protect their capital? Well, they use covenants. They have affirmative covenants, which are things you will have to do, such as you got to get audited financials, you got to pay your taxes, you've got to have insurance. And they will have negative covenants. These are things that you're not allowed to do while the loan is outstanding. So you're not allowed to take on incremental debt without their approval. You can't make distributions to the equity without their approval. So the nice part about a debt transaction versus equity transaction is the covenants are all known before you sign on the dotted line. In that credit agreement, you'll have big detailed sections of all the covenants that you can negotiate with your lender. And once the deal is signed, that's the limit of their rights. That's very different than giving someone a board seat or control of your board. That's an individual. You're not quite sure how they're going to react in the future, whereas the covenants are all written down in front of you. So a lot of investors, a lot of owners like the visibility and the transparency of a debt deal versus an equity deal. So that's all the material we have there. Gassen, any questions that come to mind for our audience as you look through this?
Sure. Yeah, Mike, thank you. A great presentation here, and really appreciated the case studies that you shared with us. I do have a few questions. One, perhaps the first one from a process perspective. You referred to the investment bankers as potentially the advisors helping companies, secure these type of financing. How are they incentivized to seek a private credit option versus perhaps an equity option? As you can tell, right, they can generate more fees on the latter than the first one. How do you come across these opportunities when working with bankers?
Yeah, very thoughtful question. So you're right. It's a bigger fee pie for an investment banker to sell a company or to get equity than it is to get debt. And there's sometimes you'll see bankers pulling an owner in that direction. It's important to say, look, I want to see both, but give your bankers firm directions as to whether you're looking for equity or for debt. There are a lot of bankers that specialize in debt transactions. That's their business. They're very good at communicating the story the way a lender wants to hear it. So as you evaluate who's going to be your banker, who's going to be your advisor, I would say the first thing is make it very clear what your objectives are, and then B, see if they're experienced in doing private debt transactions versus doing change of control transactions.
Right, makes sense. And then the other question I have, as a business owner, right, I feel like this option gives me, the best of both worlds in terms comparing to traditional debt, option or an equity option. Let's say, maybe 2 years into the private credit arrangement, I have enough cash flow. I want to stop that engagement or whatever. And is there a possibility for me to terminate the arrangement, buyout? And then what is typically the cost to do
Absolutely. So the nice part about a lender, they have to take your money. So if you're building up cash flow, they got it, and you pay it back, they got to take it. In many cases, you'll see what's called a prepayment fee for the first couple of years. So lenders want to keep their capital deployed for a couple of years. They don't want to put it out and then have it all come back in 6 months. So it's very common to see you'll pay maybe a 1 or 2% prepayment penalty if you pay it back within those first 2 years. But generally after year 3, those prepayment penalties fall off, and you could pay the debt off at no additional charge. In many cases, folks will pay it off because they've got excess cash flow, or if things have gone well and the company has grown its EBITDA, they can often attract lower cost bank capital. So private credit does a lot of work where they will help the company through that initial stage of growth, albeit at a higher cost of capital. But once the company hits 10, 15, $20 million of EBITDA, that's when banks will become more interested, and they'll refinance the private credit loan often at a lower interest rate.
Right, makes sense. The other question I have, obviously the cost of capital is one of the main reasons a private credit option is attractive, right, versus an equity option. I'm not sure, but when I was hearing the case studies you went through, I feel like I've seen somewhat a common theme coming back again and again, which seems that PE perhaps tend to put a lower valuation on businesses that perhaps the way you guys look at these businesses from a valuation perspective. Is that true or not?
It's there. There is an incentive, right? So the PE firm, they only get one shot at the purchase of the equity. They want to buy it as low as they can. So they're going to be sensitive to their purchase price because they're ultimately trying to get to a 20% plus return. Easier to do that when you're buying things low. A lender is going to use valuation as a secondary tool. What ultimately governs the maximum amount of debt is that fixed charge coverage ratio. So if you have a company that's worth 15 times EBITDA, like a software company with bulletproof 5-year contracts, they'll be worth 15 times. That doesn't mean they're going to get 10 times of debt, because the fixed charge coverage ratio is going to break down when you put that much debt on a business like that. So valuation is often a secondary concern for a lender, where it is the primary concern for an equity investor.
Yeah, no, that makes sense. And then maybe final question, I would like to hear your view on the trend recently and what's going on in the market. Is it a time where, how do you assess the current time in the market in terms of financing and rates and costs and all of that? And as a business owner, what are my best alternatives in this somewhat very highly volatile market?
Yeah, so in volatility, typically the lowest cost of capital, the least risk averse, is going to be the first to exit the market or to pump the brakes on things. So in situations where companies may have been right down the fairway for a bank and the banks are suddenly saying, yeah, we want to wait, that might be an opportunity for private credit. Our view internally is we don't want to paint every company with the same brush. Are there companies that have more exposure to supply chain issues and tariffs than others? Absolutely. So on those, it becomes difficult when you have very little certainty about tariffs and the durability of your overseas supply chain. It's difficult to forecast your future cash flow. So you want to be very cautious when taking out debt, given that uncertainty. But there are other companies, U.S. healthcare, for example, that's relatively insulated to those things. You're getting commercial pay insurance as your payer for your business, U.S. patients. It's hard to really see a tariff scenario impacting that business. So it's literally a case-by-case scenario where we're looking at, do we really think this is a good time to invest? Is it worth an additional premium in price? Or is this going to be exactly the way it was prior to April 2nd?
Great. Well, thank you, Mike. Really appreciate the presentation. I think we've learned a lot through it. There's certainly a lot to digest, and it does provide another alternative for a lot of the family-owned businesses we serve as clients. So hope everybody enjoyed this presentation. And if anyone needs to reach out to Mike, they can find all the contact information about him and his firm. I'm sure he'll get back to you and provide you with more additional details if you're interested. So with that, I'll leave it to Emily.
All right. Thanks, Gassen, and thank you, Mike, for a great presentation today. If we didn't have time to answer your questions, we'll be doing our best to follow up with you after the webcast. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance upward. Thank you for joining us, and we hope you'll join us again next time.